Right. Thank you, everyone. Let me just preset the expectations of what this presentation isn't about. This presentation isn't about tools used to monitor, predict, and prevent fraud events from occurring. What this presentation is about, broadly speaking, model governance as applicable to the construct of predictive models, as well as the specific type of a predictive model used to predict fraud losses, the so-called fraud loss model in its simple terms. What we will review are the broad outlines of model risk governance, as well as the means and ways of creating a fraud model, as well as the expectations and means and ways of independent validation, review, and challenge of a fraud model. I will pause once we clear a section to give an opportunity for everyone to ask questions, and would be more than happy to answer any. With that in mind, let us begin. Let's talk about the model governance first. Initially, models were used by the financial institutions primarily and almost exclusively in and by the trading desks, the so-called algorithmic trading models. Models rarely, if ever, were used to predict potential losses. However, post-2008 economic crisis, the Fed mandated financial institutions to undergo what's known as capital stress testing to ensure that the banks had sufficient liquidity on hand to weather financial crisis events. And capital planning exercise is impossible without the use of the models. I'm not going to go into the nitty-gritty details of how these financial models, the Fed issues its capital planning scenarios. That's not for this time and place, but in alignment with the expectations that models will be used to forecast capital requirements, the OCC issued seminal guidance SR 11.7 that really outlined the expectations that banks should satisfy, the financial institutions should satisfy vis-a-vis model risk governance. The guidance is still in force. It still forms the bedrock of the model governance compliance. And I myself had spent 6 years at EY working primarily and exclusively on the setup of the processes, controls, and also data sets definitions for the ingestion by these models. Now, broadly speaking, and from the high level, the guidance really outlines the following pillars of compliance. It's the model risk management, it's the model development, implementation, and use, model validation, and model governance. Now, when we speak about model governance, we have to be cognizant of where the risk resides within the ecosystem of a model governance. And risks reside within the three defined segments. It's the model development, model implementation, and model use. And risks are fairly idiosyncratic to each stage of model development. So, for example, when we talk about model development, risk can be that there are errors in the model design or in the model methodology. When we talk about model implementation, the risks are that there are execution errors, inconsistencies within the model data ingestion needs, and the designed and the provided model data sets. And within the model use, risk of using unapproved or out-of-date models, risk of using models that have not been calibrated. So to address these native idiosyncratic risks, each financial institution is expected to establish adequate policies and procedures to ensure compliance with the regulatory expectations, obviously to assign competent staff, to build up a framework of controls within the overall model governance paradigm, to review and independently challenge models that have been designed for the forecasting purposes. When we talk about model use, design, etc., we should think in terms of model life cycle. And model life cycle has fairly distinct stages that reside or that are owned by fairly distinct actors. So, for example, model specification and model development reside within the business line units responsible for the design and use of these models. Model validation, and I highlighted specifically, resides within the independent risk assurance function of a financial institution. Model approval and model implementation accordingly also reside within the own risk management vertical. Model use, model performance monitoring, model planning, model reporting, and change management reside with the functions that are responsible for use of these models. And each of these life stages has very distinct objectives. For example, the model validation, and we'll talk about it in more detail later on, is specifically responsible for classifying risks that are present within the overall structure of model development, mitigating those risks through the use of policies and procedures, controls, and also with performing independent validation of data sets and independent assessment of the model output analysis. Change management, that is responsible for updating the models on the basis of actual results, as well as model retirement. And, for example, model use has specific objectives to ensure that model is only used for the intended purposes, and that the controls that are embedded within the model use process are present and developed. These stages of a model life cycle, as I mentioned, have distinct owners, they have distinct intent, and there are distinct embedded controls within each of the stage of a model life cycle. Let's zoom in a little bit onto the model validation and understand where the model validation resides within the paradigm of 3 lines of defense model. So if we look at this schematic, the first line of defense consists of model developers, business owners, business users, and is guided by the overall model risk management framework. Model validation sits within the second line of defense, the overall enterprise risk management framework, and is responsible for, as I mentioned, independent model validation, model review and performance tracking, model change management, and assessment and control of model-specific risk. And then the third line of defense, our much beloved audit, is responsible for reviewing the first and second line of defense controls to ensure that each of the native processes is operating as expected, and that each of the function adheres to its own control framework. Zooming in a little bit more onto the model validation, I wanted to highlight what are the specific objectives of model validation vis-a-vis overall model paradigm. So model validation focuses on 5 distinct aspects. Model validation focuses on conceptual soundness, whether or not models that have been designed or the approaches taken to set up modeling and model forecasting engines are aligned with the theoretical underpinning specific to each approach, that the model design is consistent with the accepted industry practices, and that the non-modeled assumptions, the hard-coded assumptions, are sound from the conceptual standpoint. Model validation is also concerned with documenting the model, the modeling business requirements documents that outline A to Z approaches, and the specifically provide a detailed and nuanced view into the types of data that a model requires, the type of data sets that and the data feeds relied on to gather these data sets, as well as theoretical documentation of the approaches to building out the model forecasting engine. Obviously, implementation, how are the models implemented, whether there are functioning model change control procedures, whether the controls embedded within the overall modeling process are operating as designed. The focus is also very specific to data quality, whether or not the data libraries that have been set up are aligned and relevant to the specific model use, where the data extracts are aligned to the data libraries, whether occurrences of missing data are remediated, and whether or not the upstream and downstream consumption of data sets through the data aggregation hubs are documented and tested for accuracy. And lastly, model performance, whether or not the outcome of each, whether the outcome of the forecast is aligned with its, and within the predicted parameters of the outcome, whether or not sensitivity analysis produces accurate assessments on the outcome of the model forecast, and whether models are back-tested to the challenger models to ensure accuracy of the output. Within the overall model governance, model validation has a very distinct role to play. Just as an overview, when we talk about model governance and oversight, we need to specify that banks are required by the regulators to establish functioning and robust model governance framework. When we talk about documentation, we need to keep in mind that banks must maintain comprehensive documentation of their models, comprehensive documentation of the data sets used by their models, means and purposes of extracting the data, the data schema definitions, as well as the data library setup. When we talk about ongoing monitoring and review, financial institutions, banks are required to monitor and review the model performance, as I had mentioned, to backtest results of the forecast and to perform outcome analysis. And obviously reporting, financial institutions are expected to regularly report on the results of the model use, on the accuracy of the model predictive forecast, and on the change management to ensure that models are kept in line with the latest developments, either in the methodology or latest changes to the required data sets. So when we talk about the model validation has two distinct areas of concern that are bifurcated as follows. There is model validation in and of itself that touches upon the conceptual review of a model, that touches upon the accuracy of the data and whether or not data is fit for purpose as specified in the model documentation. It's focused on the parameter calibration, meaning that is the data used by the model fit for the forecasted purposes, and whether or not potentially different data elements or potentially different data sources or data sets have to be used, and whether or not conceptually the model is fit for its stated purpose, whether or not the outcome of a model forecast is aligned with the expected output. And the second area of concern or area of focus for model validation is model testing. As I had mentioned, it's backtesting the model to ensure that the model results are challenged by the challenger models. It's the sensitivity analysis of the output. It's the stress testing of a model, meaning that if factors that might not necessarily be specified within the model parameters are introduced into the forecasting engine, the model doesn't break down and still predicts or is still able to produce a forecast, as well as benchmarking to models used either by the industry or by a master challenger model. So broadly speaking, when we talk about the model governance, there are really four components that are applicable and that really define the model governance in and of itself. It's the model identification, which tools are really models and which tools are monitoring tools. Model development and implementation, the types and sources used by the model, the data relied on by the model, the specific components of the data libraries that are data repositories that are used to produce these model data sets, model use, definition of the model owner, assigned responsibility for maintenance of the models and model documentation, exceptions to the policies, as well as model validation, the crux of our discussion, assignment of responsibility for validating the models, defined approach for validating the models, as well as the distinct invested responsibility to perform an independent review and challenge of these models. Are there any questions before we proceed further?
Yeah. Can you run by again the back testing? What's the, maybe by way of example, what does the back testing look like?
Sure. So you have a model produces a forecast, right? The forecast is produced on the basis of defined data sets and defined assumptions. To backtest the accuracy of that assumption, validators rely on a different model that is not used in production, the so-called challenger model. That model might be constructed on the basis of different methodology, but the expectation is that if that challenger model relies on the same data set that's ingested in this forecasting engine, then the results, the output of the challenger model, which might be, again, as I mentioned, might be constructed using different approach, approximate within a reasonable degree of accuracy the output produced by the production model.
How does one, let's say that we're doing damage calculation, we have a model, fraud model, same thing. How do we avoid the internal bias of the person doing the first model to do a collaborative model that also has this maybe unsensed or internal bias that is somehow...
Sure. And that's a great question, and we will talk a little bit more in detail about these topics, but broadly speaking, there are two venues, and this is actually an excellent segue. There are two sources of models that a financial institution can rely on. There are internally developed models, and then there are externally developed models, right? So if the question is, how do we assure that the bias that might have been baked into the design of an in-house developed model isn't present in the challenger model, well, that's where the third-party vendor models come into play that are constructed outside of an ecosystem of a specific organization. All right, and as I said, this is an excellent segue into the slide. When we talk about the in-house models and we talk about the third-party vendor models, both have its own pros and both have its own risks, right? So let's talk about the in-house developed model. specifically focusing on the data used for the model. That data leverages information that's already known, right? It comes from the native data repositories. Anomaly detection that is expected to be produced by that model is based off the actual events that have taken place within the ecosystem of a financial institution. Therefore, they are reflective of a risk profile of the clients, products, transactional activities, etc. The clustering and predictive accuracy of an in-house developed model, again, since it's based off the actual events, it's more native to the risk profile, and therefore it is more accurate in that sense. And the integration of data libraries upstream and downstream is much easier, since we institution is relying on its own IT systems. However, there are risks to the in-house developed model. The risks are, again, fairly idiosyncratic. Delayed adoption of an ever-evolving fraud pattern. For example, the institution, such as financial institution, isn't necessarily set up to identify and actually design what the future fraud event that has not occurred might look like. Therefore, if a fraud event has not occurred in the ecosystem of that institution but has occurred someplace else, that type of a fraud or that type of a fraud loss, to be more accurate, would not necessarily be accounted for into the model setup. There are baseline risks, and we've touched upon that briefly. If the data sets predict embedded biases, lack of awareness is present at the baseline level, then these risks, unless they are addressed and identified, are inevitably going to be reflected in the construct of a model, because these unknowns, as it were, is fairly difficult and not impossible to account for. And also, an in-house model is limited to the technology environment that is native to that financial institution, which might be cuddled together, which might consist of legacy systems, and which might not necessarily be reflective of the latest and greatest. Now, looking at the third-party models, there are obviously benefits, such as third-party models based on a wider fraud events that have occurred, since those are gathered across different institutions, right? So they might predict and they might provide a wider span of these fraud losses. At the same time, they also might be somewhat limiting, because the fraud events that the third-party models might be focusing on are the most likely fraud events that are most likely to have occurred, or that to occur for a given institution type, and therefore very unique but very injurious fraud events that might only be present within one-off institution are not going to be reflected here as well. The anomaly detection as well is based off the most likely fraud event. And lastly, and probably more seriously, there is certain data handoff between the financial institution and the third-party vendor model. In that handoff, financial institution loses fidelity and control over its data sets. And while there are processes to ensure data fidelity, there are black swan events that might take place, and the fidelity of the data might be lost. When we focus on the third-party vendor models, there are additional risks, such as misalignment of the idiosyncratic risks that are native to one financial institution to the predictive engine of a model that is based on most likely idiosyncratic risks. There are mismatched tail events, such as misidentification of a fraud event as a non-fraud event, or on the flip side, identification of a non-fraud occurrence as a fraud occurrence. But unfortunately, there is no panacea, there is no silver bullet, as it were. Financial institutions do develop most of their predictive models in-house, but as mentioned, third-party vendors have a distinct and defined role to play in challenging the in-house developed models. The rule is the more complex and the bigger financial institution, the more likely it is to develop its model in-house. And obviously, when we talk about community banks, those are most likely to rely on the third-party vendor models. What's involved in the fraud model validation? The requirements for a fraud model validation are not different than the requirements for any other model. There has to be an evaluation of conceptual soundness. There has to be maintenance of ongoing monitoring, and there has to be outcome analysis on the model outputs to ensure its predictive accuracy. That's a short segue. Now, when we talk about fraud models, there is a myriad of fraud events. I myself had been a victim of old-fashioned check fraud, when I literally mailed my check and someone intercepted it, added an extra zero, and that check was cashed. And luckily I caught it in time. I went to my banking financial institution, and I was reimbursed for my loss. But the ecosystem of fraud events obviously is ever evolving. We'll talk shortly about the most concerning fraud events, but the safeguards to ensure that fraud events do not occur or that are mitigated in time are tried and true. It's the existing of a comprehensive assessment framework. It's the appropriate detection of red flags. It's risk rating of client, product, transactional profiles to identify what those risks are, and we will talk about it later on. There is a risk characteristics assessment of what is most likely to result in a fraud event. There is a collection of data and assessment of data accuracy, and obviously there is a third-party vendor management. The fraud events that are of probably utmost concern are what's known as biospoofing, which is enabled by the AI algorithms and the generative AI that can mimic an individual's voice and appearance. To really do that, what these AI algorithms really need are just a few phrases, just a few words, and also just a few pictures to really create an accurate spoofing or biomimicking of an individual's traits. So let's take a look at a potential scenario where deep fakes are used to compel innocent individuals to act in a manner that they probably wouldn't had they known that they're not speaking to a real individual. There was a real good an actual case where someone in a financial institution, I believe it was in Hong Kong, got a phone call from their CEO, who instructed that individual to wire money to an account. Obviously, that was not the individual CEO. That was an AI-generated voice prompt. And these algorithms are really good to such an extent that they can have what appears an intelligent conversation with an individual. I don't know if that means that these AI algorithms fail or pass the Turing test, but that has already occurred. Additionally, deepfakes are on everyone's mind, and I'm not talking deepfakes from the political standpoint, even though that might be a concern. But let's say an individual has a scheduled Zoom call with a bank officer or with their account officer, and that account officer might fully be convinced that he is speaking to an actual individual, whereas in fact he might be speaking with an AI-generated image. The individual on the left, this nefarious looking figure, actually is AI generated image of an actor who played an imperial admiral in the very first Star Wars film. That actor had passed away in 1994, and his likeness was generated almost 20 years later for a Star Wars spin-off, Rogue One, where he played, if you can call it in quotation marks, in a number of scenes, and by all accounts, the individual's likeness and the individual's voice was recreated with an astonishing degree of accuracy. I wanted to include this specific snippet because this was the very first instance where an AI-generated likeness and AI-generated voice patterns were used for a major Hollywood production in a number of scenes. And I think that in and of itself is an indication of how far and how advanced the technology has progressed. Broadly speaking, when we talk about the fraud model, we really are speaking about the two types of variables that the fraud model depends on. There are dependent variables, and we'll go through them later on, such as the customer risk profile, product risk profile, transactional risk profile, and then there are independent variables such as a loss score, probability score, vector score. Conceptually speaking, the independent variables are applied to dependent variables on the basis of baseline worst case, best case scenarios provided by the Fed for the purposes of capital assessment and forecasting. The model algorithm forecasts what those losses would be on the basis of the dependent variables, and the outcome is either and the outcome of these losses is further fine-tuned via the model overlays and via the outcome analysis. Now, the good thing is that the definition of these variables is up to each specific institution, right? There is no one size fits all that is relied on to define what those variables are. The example that we will go through is not necessarily specific to any institution, but it provides a sort of informed view of what the setup of these dependent and independent variables looks like. I had, as I mentioned, I had spent a good amount of time at EY doing exactly that, doing through the data libraries, defining the characteristics, linking the characteristics to the loss scores. But the example that I'm walking you through is not indicative, nor is it prescribed, nor is it specific to any particular institution. What we have at the top is one specific data set for a specific customer, right? We have the demographic data, we have the product data, we have the transactional data, we have the fraud risk data, and we have the account data. The numbers here indicate the number of occurrence for each event. So when we zoom in on the demographic customer risk profile on a scale of 1 to 5, 1 being low, 5 being severe, 2 being elevated, 3 being medium, and 4 being high, we can assess that this customer, geographical location, demographic location, past history, and let's say that on the basis of these determinants, on the basis of this risk assessment, the customer's risk profile is rated a 3, medium, right? Then we look at the product risk profile that the customer engages. He writes 2 checks. He's got one brokerage account. He's got 3 credit cards or 3 transactions in the credit card. And on the basis of that mix of the products, let's say that the customer profile is risk profile is set at 2 as elevated. Now we'll look at the transactional risk profile, and when we see that he writes 4 checks, he's got 5 wire transfers, he has 4 ATM withdrawals, 5 online payments, and again, on the basis of these characteristics, the transactional risk profile is set as 3. When we look at the fraud profile, we see that the customer did have one fraud event. The fraud event is a wire that was sent out by the customer in error. The loss amount is $2,000, and that risk profile, just by the virtue of its occurrence, now is rated as 5, the most severe rating. Identification of this is a very simple schematic, but the identification of these variables and the risk rating of these variables is really based and dependent on methodology and means of getting to these risk ratings, getting to these risk scores. Now let's take a look at the independent variables using the very same data set that we have. So let's say we have a severity score. And severity score is the impact of a fraud event based on the customer profile. Again, same demographic data. He's got $5,000 in cash. He's got $1 million in his investment. Potentially the severity score is set as medium. We look at the vector score, where the potential fraud came from, right? What's the potential exposure based on his account activity? And we see that, he wrote 4 checks, 5 wire transfers, online payment. We know that the fraud event arrived through the wire transfer. That's the vector. And based on the characteristics, we set the transactional risk profile at 4, high. We look at the probability score. Probability score is based off the actual aged event. We know that a wire was sent in error. We know that the wire amount was $2,000. The wire was sent 14 months ago, so potentially the client has learned his lesson. Again, there are grades of the aging timeline. Let's say that 14 months is far into the past enough that it no longer warrants high, but maybe warrants a low probability score. Then there is a loss score, assessment what the loss would be for the bank, given that last event was $2,000, and let's say the loss score is set as 1 is low. And then we have risk identification score. Can the bank monitoring algorithms prevent this fraud from occurring? He wrote 3 checks. He had 1 credit card transaction. He's got 2 brokerage transaction accounts. All these were done within the environment of a financial institution. Therefore, the product risk profile, meaning that the bank can identify nefarious activity happening on the basis of the transactions, is set at 3 as medium. I know that was a lot to cover and quite detailed as well. Are there any questions before we proceed?
Yeah, I have a question. I just have a question. I think the participants should be advised that the Statement of Standards for Forensic Services, paragraph 10, prohibits members from coming to a conclusion of and calling it fraud in their reports. So we should also be aware that we cannot come to an assessment. That's for the trier of fact.
Okay, thank you for your comment, Dennis. Anyone else?
Yeah, I replied to Dennis privately. I think this is a colloquial speaking among friends here, and I think that the statement should not be there was fraud, but some sort of a qualified couch statement such as we provide findings that are indicative of certain activity that could be determined to be fraud.
That's
and
true.
that's what I think that's just in the.
That's true. There's a distinction, right?
Absolutely.
Right, and thank you, Gal. Thank you, Dennis. Just to underline, we're looking at the setup of fraud model from the perspective of internal banking financial institutions. Obviously, no one's issuing a report. So for the purposes of this paradigm, as it were, a fraud event is a real fraud event that has occurred. Right. So once you've defined your dependent variables, once you've defined your independent variables, really they're put together, as I had mentioned, in this massive data set that aggregates all of the transactional activity by the client, by the type of a product, by the transactional activity, by the actual historical fraud events, aligns the risk scores, and this massive data sets then are fed into the model that on the basis of its methodology, on the basis of its construct, predicts what the losses would be like given baseline, best case, and worst case scenario by the slices of the clients, by the products, by the geographies, etc., etc. This is really done, again, to keep in mind, not necessarily to predict a fraud event. It's mostly done to estimate the impact in dollars, what the fraud event would be like for the purposes of capital planning. I think we're running out of time, so I'll just go through quickly the next few slides. The fraud model documentation sits in the number of defined buckets. It's quite extensive. Obviously, we have anti-fraud governance that stipulates overall model risk management policy, model risk governance roles, model validation policy. These are top level policy level governing policy level documents. We have the fraud risk assessments that produces the fraud risk map, heat map, that stipulates financial institutions' anti-fraud strategy, that defines and determines the development and remediation plan, that sets up risk taxonomies. When we have the anti-fraud procedures, what are the data analytics, what's the model inventory like, which models are specifically defined as fraud predictive models, what are the fraud risk characteristics as part of the overall RCSA, risk control of self-assessments. We have the prescriptive fraud investigation playbooks that stipulate activities once fraud has been identified. There is anti-fraud culture, fraud awareness and training, defined roles and responsibilities, and obviously change management that touches upon overall policy, governance, model constructs, etc., etc. The representative pillars of the model validation touch upon input data analysis. They touch upon conceptual soundness and fit for purpose, touch upon the outcome performance analysis, and also touch upon the governance frameworks and implementation. The activities embedded within the validation cannot be divorced from the controls. This slide presents a very simplified schema of what is involved within the model build-out life cycle. So you have to manage the model that constitutes policy and procedures, controls assessed by audit, controls designed and independently tested by the second line of defense. There is a build the model that's based on the historical trends, again controls to assure accuracy of those data, product and transactional characteristics, controls that are meant to ensure accuracy of those, client profiles, emerging risk assessments, and there is run the model, actual execution, which depends on the quantitative, qualitative factors, it depends on the escalation pathways and the application of the rules. There are adjustments and overlays, actual versus expected, the assessment of data, whether data is right fit for the purpose, and again the associated native controls, and the outcome follow-up based on the risk profile update. I'll skip through the slide, and I only have 2 slides to go through. So broadly speaking, what would be the activities performed by model validation on the inputs, i.e. the data? Well, the activities would be review, and the target outcome would be to identify current state and a desired future state, and to develop a comprehensive strategy. The assessment of the change management and systemic updates, and the target outcome would be to identify transactional code fidelity across various verticals vis-a-vis the golden source of the active transactional data, map out, perform analytic techniques, and identify reports, and the target outcome would be a comprehensive strategy to pinpoint and prioritize mitigation of identified gaps, as well as the identification and training, and the target outcome would be to provide specific fraud risk training to all identified levels of staff and management on an enterprise-wide basis. And the focus on the outputs would consist of periodic assessment with a target outcome to ensure enterprise-wide training, fraud awareness of the fraud events, and assessment of each year's transactional data and actual fraud events, an estimate and the impact of the likelihood, and the target outcome would be to document these findings and conclusions and to strengthen the existing activities. Execution and report of the on the analytics, and the target outcome would be to document findings and conclusions within the fraud risk assessments and establish the fraud risk governance structure, and to establish communication and procedure pathways with the target outcome to ensure and establish enterprise-wide fraud response protocols, communication, and monitoring mechanisms. And I think I have come to the end of my presentation. Are there any questions?
Yeah, are these slides available?
I believe they are, and I can share them with you as well.
Another question I have too, because you have to permit me, forgive my stupidity, but I'm just a boomer here. And I want, these tools are just for assessment purposes, right?
So as I had mentioned at the beginning, the fraud model for the purpose of my presentation is meant to predict potential losses on the basis of fraud scenarios and on the basis of fraud events, on the basis of scenarios provided by the Fed, reflective of the actual fraud events that might occur, given the type of customers, type of transactions, types of products. So it's meant to predict potential losses from fraud events, not to predict fraud event in and of itself.
Good, thank you.
Any questions? All right, well, everyone, thank you very much for your time. It was my pleasure to present at the committee for the first and hopefully not for the last time. And if you have any questions, please feel free to reach out, and I would be more than happy to address them offline. Thank you very much.
Jan, thank you so much, and thanks for sharing your expertise with us.
Excellent job, Jan. Very good.
Appreciate it very much. Yes, thank you.
Thank you.